It's funny. Jay wasn't super like giddy and excited. Like we're going to talk about multifamily, which is our industry. But when he finds out you're an actor, he's like, we get the little schoolgirl. Like, oh my god, have I seen you in anything?
I'm as excited about that as multifamily and that.
Welcome to Drunk Real Estate. Grab a drink and enjoy the show.
Hey there, welcome to episode 108 of Drunk Real Estate. I am Kyle Wilson, Ashley Wilson's husband, and I'm joined by my normal guest host, Jay Mauricio. But today we have a very special guest host because AJ's off, I don't know, shooting animals or something. And we have Charlie Koznick joining us. Charlie is he's been in multifamily acquisition since I think 2014, I think I was reading. And he's currently the chief investment officer for Ken McElroy and MC Companies, which owns and operates like 7,000 residential units, I think I saw last, and 29 properties in Arizona, Texas, Nevada, 1,000 additional units under construction and development right now. So you got a lot going on in multifamily. So obviously we're going to be talking about multifamily a lot today. But more importantly, when I went to look your name up, the first thing that popped up was not MC Companies, wasn't your previous multifamily experience. It was top 300 hottest actors in 2013. So that is you, right? Though
that is, yes, that is you. We are the same person. Yes.
Does he have a lot of chest hair like AJ does, or how's the chest hair going? I'm guessing there's a lot of chest hair there going, Charlie.
There was, but it was trimmed on set by hair and makeup. So,
with all this discussion of actors, I've known you for I don't know how many years. I know we initially met like over a decade ago, I think. But like as I'm staring at, maybe it's the camera. The camera changes. There's a little bit of a Tom Selleck look right now. Have you ever gotten that before?
I have, yeah.
Yeah, there's definitely a Tom Selleck in there somewhere.
I actually I did an episode of television where it was him and I battling for a hotel. So I got to do a scene with him where it was on the show called Las Vegas, and he owned the casino, and I was getting married to Vanessa Marcel on the show, and I was trying to take over the casino. So I got to play him in the scene for a hand. We were going to play for the casino on one hand of poker, and he says, "You want to bet the entire hotel on one hand of poker?" And I had to turn to Tom Selleck and say, "Why don't you show me that big set of balls you're so famous for?" That was my line. It took me about 35 takes to get that out with a straight face.
And I assume that wasn't the last episode of Las Vegas ever shot, so you didn't win the casino.
It was the last episode of Las Vegas ever shot.
No, it wasn't.
Yes, it was.
That's awesome.
So it was supposed to be just a season finale, as in the last major part of the last two episodes. It was supposed to just be a season finale. I was coming back for season 6 to continue this battle. And then we got a call like a month after we wrapped that the whole show just got canceled. So it ended.
Really? Oh,
yeah.
That was I remember watching that a little bit. That was back in what year was that? That was like 2010,
like 2009, 7, 8, 9. It was really popular. Yeah.
So how do you go from that? That seems like you're like maybe a working actor, but you're doing pretty well. I mean, you're not exactly doing, diaper commercials or whatever. Actually, that's not a bad thing either. But then how do you go from that to like, let me stop this and let me go do some multifamily?
Well, so I was a finance major and was working at Morgan Stanley for them when I was in college and interning. That's what I was going to go do. And then I had a friend call me my senior year, and I'd not seen him since 4th grade. And he calls me and says, "Our moms ran each other at a grocery store. You should come up for my 21st birthday." And he ended up being in Mad Men, Vincent Kartheiser. So he called me. I went up and his agents were there and managers and were interested in talking. And so I decided to scrap the whole Morgan Stanley and have that fun conversation with my parents that I was not going to go into financial planning. And then it was fun. I loved it. It was an experience. I met my wife in Los Angeles. But I kind of looked at it as skydiving. So when you skydive, even if you pull the chute, if you pull it too late, it doesn't matter that you pulled the chute. And so in that career, it was the same thing. Like, well, you don't get out at a certain point. Like, how do I enter the workforce? If I got to just make the decision, like, am I comfortable with this being my path? So I went back to UCLA, went through the real estate program, and then I just started doing triple net lease stuff where I was just funding it through friends and family, entrepreneurial, and buying deals and syndicating them that way. And then I ran into Ken and had an opportunity to pitch myself and told him what I was up to, and he saw the entrepreneurial spirit that I was running my own gigs, and wanted to know if I wanted to join a team and jump to multifamily, and I took that opportunity.
It's crazy. We've got a professional actor here, a professional athlete. People don't know this, but Mauricio started with an OnlyFans account, and I think I'm the only one that actually that went directly into the workforce.
No, dude, you were a professional poker player. What are you talking about?
You were professional though, right? Like you were just like, it was a hobby and you were just really
Semi-pro.
good at it.
You were making money.
It wasn't OnlyFans. That's
all right. Well, Mauricio, for the record, you were the one who derailed this topic. We didn't get right into the topic talking about multifamily. I brought it up, but you started asking questions about how do you get started and do all that stuff. So it's your fault.
Charlie's a fascinating character. Dude, you and I, first, when you've worked for MC twice, right? Like you worked for them. That's when we first met, like, I don't know, a decade ago. And then with the slowdown, you moved on to something else. And then you came back. Like, I remember, like, he's back.
Yeah. So I came back. I was gone for 6 years, and then I came back. So I've been back since 2023. I came back.
Yeah. Sorry, Kyle. So I apologize for derailing you.
I would talk about that all day. Like I obviously I have I don't want to call it a similar path, but like I played pro hockey until I was a similar age, and then like as you said, like it's not like I made enough money to just sit on my ass all day. I had to go and figure out what I was doing, and luckily my wife was already.
I was gonna say, luckily you married up in life and got it made.
But like he went to school, and it was like in economics, and then became an actor. Like I went to school for physics and became an athlete. Like it's like kind of like, how does that make sense? But no, I find it super interesting. But you're right, we should talk about business here. Apparently our numbers need to keep up, and we got to get right into it, or people start dropping off our podcast. So since this is a multifamily episode, and there is a lot of stuff in the news going on right now in the economy, we have Jay talk about different updates with inflation, interest rates, all these different things. A lot of people in multifamily are scared. They're pencils down. They're saying, I don't want to touch this industry or other commercial industries right now until I have a little bit more clarity going on. But from what I heard from Ken, it sounds like you guys don't have that opinion right now, that you guys are like full steam ahead. Is that kind of, am I reading that right?
Yeah, no, we did a recap as well internally with an institutional partner. But if you include all of it, I think we're like 600 million in the last 10 months of transactions of purchases. So, we are very blessed that we have a very long-term horizon. Our investor base understands that we're not the burn and turn group. So that longer horizon allows us to take, I think, advantage of a little bit more opportunities. We're not driven by these outsized massive IRR numbers. And so we see it as an opportunity to, especially we really have focused on, we bought a small little value add deal, but that was just a super unique situation. Long-term owner, 25 plus years, went to his son. He wanted to get out. It was their only deal in Phoenix, and they were trying to self-manage it from Florida. So that was my 8th LOI in 7 years on the deal, and we finally got it. So I've always wanted it. I thought it was a hidden little gem. So, but outside of that, we're really sticking to kind of the Class A, newer construction, 2019, 2018, and newer product. And that's stuff that in the past, when it's frothy or even doing mildly well, it's just stuff we can't compete on and get our investors a chance to get into. We can't compete on a 7 or 8 IRR and all cash closing. And so, we look at it as there's headwinds. I think there's headwinds coming. I don't think it's going to be an easy slog, but the stuff that we're picking is really well located assets in really great locations, and they're depressed in terms of pricing and on rents. But the rents are depressed because there's just so many options. It's not an actual we can't afford it. That's why the price is coming down. Phoenix demand is the highest last 24 months. I think it was demand was just over 32,000 units, which is, I think normally we're like 8,800 units. So demand is through the roof. It's just a supply issue. We had 27,000 units in the same 12 months. So we still had more. We had a net absorption, but people are still moving here. We still have a lot of in-migration. And so that renter, that Class A renter is getting a discount just because they have so many options at their fingertips. It's not we can't afford it. So
But Charlie, why now though? I mean, people have been moving to Phoenix since I lived there a decade ago.
And just to clarify, so 600 million, that's about 2,000 units, give or take. Are all of those in Phoenix, or all of those Class A, or is Phoenix?
Majority are in Phoenix. Phoenix, Tucson, and then one deal in Dallas, one deal in Las Vegas. Most of it is in Arizona.
Okay, so yeah, Mauricio, then that question.
Well, yeah, I mean, where I was going with this, just so we can help the audience too, because there's a lot of, like, to Kyle's point, there's a lot of folks that are scared, they're not quite sure. It's it's like, you don't want to catch the falling knife. That something has turned in your world in the last, I don't know, in my mind it's like a year, maybe it's even more, and maybe I just didn't realize it, but like something switched where you went from, dude, pencils down, we're not doing anything, like whatever, and then suddenly now you're like, we're buying like there's no tomorrow. Like what are you guys seeing in the market that's making you think that this is the time now, that it's time to get in now? And you told me earlier that you see like a window of time to get in, and whether it's 18, 24 months, right? So what's changed in the last 12 months that has made you say, hey, it's time to just go in? It sounds like you're all in.
Yeah. On the Class A side, we've seen a real bottoming and kind of a stabilization of what the bottom pricing is going to be. There hasn't been an uptick in pricing, but it's stabilized. And so by the time there's an uptick, you're going to start getting the big players in there that we just can't compete with them to buy these kind of really corner of Main and Main properties that, we're looking at. The last, we're going to make our money in years 5, 6, 7, 8, 9. Like, they're not, this is not huge money makers in the first 5. We're going to make it on the back end. There's a Dean Widener is, a massive owner in the multifamily space, all on his own, right? I think he has 65,000 units, and I think he has 2 partners left and maybe a handful of those deals. And he is notorious because it's his own, he sees the longer picture, and he comes in and buys stuff when it's a little bit tougher for everybody else to make it pencil, because they're looking at that. I need that 3-year, I need a 19 IRR. So everyone just puts their pencils down, and he buys stuff, and years 6 and 7, he's crushed it.
And so how are you crushing it in year 6 and 7? I mean, if you're going in Class A, new stuff, presumably cap rates are in the 5s, just
high 4s. It's really still high 4s, yeah.
Okay, so high 4s, negative leverage, low cap rates. Like, where's the value to investors come from? I don't mean that in a bad way, but where's the value? Where's the value in these deals? No,
but honestly, that's a fair question, right? Because the negative leverage on these deals, it's not significant. We have timed them very well, just by not a crystal ball, where our debt's in like the low 5s, like 5.1, kind of where you buy. Like, there's a fairly significant appetite for this really well located stuff, and so we're like 5.1, and it's a 4.95 cap. So you're not that far away off. We need to be able to see like a path to getting to positive leverage within the next 12 months quickly, and then after that, I think if you're going to buy into, I'm going to buy this on a basis play, right? Then you've got to believe in outsized rent growth coming. And so we think the rents that are depressed in some of these areas that we've seen them be, you're looking at rents that in 2022 were $1,900 to $2,000 are now $1,400 or $1,500. And that's why you're buying the 4.95 cap. If you believe there's a path back to, in time, that $2,000 rent, and you can get that lift, we're not actually counting on if cap rates compress, that just makes this deal all that much better. We're not counting on that. We're just counting on, we think that the rents are compressed and down due to the oversupply, a massive oversupply, and the ability for people to have so many choices. And
have they bottomed? Have they bottomed in Phoenix? Because I know Phoenix was one of those whiplash areas, right? Like there was a few, like Austin, where like you had a lot of supply come on. A lot of people were building because the rent growth was so high before, and there was so much like population growth and everything going on. And then, but the whiplash effect is like Phoenix was also one of the drivers of, we've seen rents coming down. We've seen, rent decreases instead of the typical rent increases. But it seems like a lot of these areas are bottoming from what I've seen. We don't do Phoenix. But like even Texas, there's a bunch of areas where we're bottoming. We're seeing it start to uptick.
We're
again
seeing
now.
that in Houston.
Right. And so like, is this Phoenix? Do you think we're at the bottom for rents and that it's going to start heading back the other way?
In pockets. Phoenix is pretty segmented between East and West. So I think East, you've started to see some of that flattening. I mean, there'll be pockets where it might come and go just based on a specific deal being built in your 1 mile radius. I think the West Side's got has a much longer runway. There is just that was where all the farmland was. And so people just built like crazy. So I think that's just pockets of it are going to take longer to come back. But I think in really well located, your Chandler, Gilbert, Scottsdale areas, yeah, you'll seen kind of the bottom pricing.
Right. And so I assume you guys from I'm listening to Ken, first of all, you guys are more like long-term people, right? Like you don't mind holding things 10 plus years. And I guess our investment thesis right now is a lot. If I had to sum it up, it would kind of be permits based. Like if you look back, everyone was saying the sky is falling, right? They were saying they were seeing how many permits were in the pipeline and coming online. And they said 2024, 2025, we're going to have 1 billion units come on and everyone's just going to get crushed. And we did hit see outsized. But to me, like no one really got crushed. You saw some softening in rents. You saw some absorption, maybe go a little negative, but there was a lot of places where it didn't. And we've already seen the number of permits drop off a cliff. And so to me, if you can kind of project it, it's very market dependent. As I said, you guys in Phoenix had a lot more and longer than in Austin, and then maybe somewhere like, even Dallas or Houston or somewhere like else in Texas or Florida. But so you kind of have to project where you guys hit that bottom with the permits and stuff. But I guess a lot of our investment thesis is based on this fact that, to your point with A class, there's nothing coming online compared to population growth and the demand for rentals in these next couple of years, depending on when your market bottoms. So like, I assume like Phoenix, like an opportunity like that, where you did see that huge growth and you saw a pullback, that if you're kind of getting in now at a good basis in these A class things, that you might not see it in the first 6 months, but like a year from now, 18 months from now, like we should really be set pretty well.
Yeah, and that is a massive part of these. I think everyone got real excited when they saw the completions and the units coming online, hitting. It's like just got to get 2025 that's when it peaks. You're gonna be fine in 26. The problem is it lags. Like no one thought about you actually have to lease all those things up. So I think it's gonna be probably soft all the way through 2026. But again, this is if I buy a deal in Phoenix at $280 a door, if it goes to $270 a door on paper, like I'm okay with that on my long-term thesis play. I'm not trying to time it perfectly. And if it goes to 270, and that's when everyone starts to go, this is amazing, and there's that couple of months of everything going up, then all the good players that can outdo me on terms are all going to come in, the big boys, and you're going to watch that go to 270 to 340. And I'm going to say, man, if I just would have bought it 280, I'd have crushed it to 350, right? But I was trying to time the bottom of that. So if I put low leverage, long-term, longer term fixed rate on this, and we're playing this for the end game, we think we're in a really good position.
So when you say it's a longer term, what kind of loans? Like I would say, what's your gold standard loan for your first base level underwriting, right? Like if you're buying a property, obviously it's got to be 90% occupied, but any normal property, 90% occupied, what's your like target loan that you're just going to use for your first pass underwriting as far as length, and like, because I guess the thing that I feel like we go, once again, we go in these like in these cycles where so many people got these floaters, and we got one floater that we're still dealing with right now, because they went through that up run in the late 2010s where the values would go up in 2 years and they would be opportune to sell But the problem is you got this, 10-year fixed rate loan on it, and you would have a 6% prepayment penalty, or even, you'd have $6 million prepayment penalty on these things. And so then it kind of flew back the other way. Everyone's like, well, let's get floaters, right? Like interest rates are zero. Like it's, we're paying nothing on these floaters because we want to exit. We want to be able to get out whenever we can. And now, obviously, with all the floaters are having issues, I feel like everyone's flip-flop back to the other side where they only want longer term fixed. But then I'm kind of saying to myself, like, okay, what happens if we do see that softening and 3 years from now, all of a sudden we're back down and interest rates are a little bit lower and cap rates are back in the sub fives, like when we want to be able to sell these things, then we're going to be stuck with these 3-4% prepayment penalties again. So like how are you balancing that? Like what kind of loans are you guys looking at?
Yeah. So we'll normally start at a 7-year with some sort of step down prepay. It's a little bit pricier on your spread, but we kind of, again, that gives you a little bit more of that flexibility. We've been doing 5, so we can take advantage of that kind of 3-year. If it is in year 3, we're down to a much more nominal number on our prepayment penalty. So the art of the float, if you can do it, is really, really, it can be a beautiful thing. But we're buying these assets, and if it's year 4 and that it spikes, then I can sell it for a price I didn't even think I was going to be able to sell it for, and I'll just eat that prepayment penalty if that's the right choice to make. I mean, but I don't see it going anywhere inside of the next. I don't see it being this boom in the next 2 years in pricing. So if I get to year 3 or 4, I actually don't have that much yield maintenance left on, by the time I get there.
What's your investor profile? I mean, you're obviously your typical investor in these deals is looking for something to place their capital in relatively long term. They're not necessarily in need of cash flow short term. But I mean, do you go in with the thesis that we're going to hold these things for 10 years? If we happen to get out sooner, great. Or do you go in with the thesis we're going to hold these things for 4, 5, 6 years, and if it happens to be 10 years, oh well?
No, we go into it. I would rather have my investor know what it looks like if it is a 10-year hold. And if it right, it's like if you go to a maitre d' and they said, hey, the wait's going to be 50 minutes and it ends up being 25, you are ecstatic. But if they tell you it's going to be 25 and it ends up being 50, or if they tell you it's going to be 10 and it ends up being 25, you're pissed, even though you both waits for 25 minutes. So I'd rather pitch it under the thesis of, hey, we're going to do this. We're going to do a refinance in year 5. And this is how you're going to get to it in year 10. And then if it is better than that in the short run, then it's a win for everybody.
But is your goal, because I know Ken throughout all these years has really, maybe, I don't know if he was the pioneer of this, but certainly the infinite return model is in Ken's, I mean, his whole logo is, I think, infinite return stuff. So is your goal to hold these forever in terms of just refinancing them out and getting investors capital out through refinances and do that 2 or 3 times? Or is there really a 10-year, the plan is to really exit these and sell them in 10 years?
It all depends. I mean, again, it all depends, right? If you're able to, if the model works where you can continue to refi, give large chunks of money back, and then continue to hold it, we'll always go that route. But I think we have to be careful of, and I think what we're going to try to do is have a little bit more balance inside of MC, have those nicer, newer assets, and then I think there's a wave coming of kind of that what I would call the B and C stuff, that our thesis is going to be a much shorter term hold. And so if you invest with us, right, we're kind of diversifying that for you. So you got some stuff where you're going to be a little bit like a blue chip, and then some others, you can sprinkle some stuff in that's going to be a little bit more of the distressed that's coming in the next.
Yeah, let's talk about that, because for many years you guys have been known as like the B plus, really B plus, I would say, asset class, and now you're talking A class. So has that been like a shift in your thesis, a shift in your underwriting? How would you describe that shift from being a B plus investor to now investing a lot in Class A? Or is that just what the market's giving you, so you're taking it?
It's what the market's giving us. It was a thesis we looked at because we do new development. It's not like we are just a value add guy entering this space and we don't understand how to do, deals that are just maybe not quite stabilized in lease up. We understand all of that piece because we do development ourselves. So it felt like a natural transition. And I just don't think the bottom is anywhere near where it is on the B space.
Well, competition too, right? Like A class, it used to be just impossible to compete with some of these big shops with their cost of capital being single digits. And now a lot of them, to point, are pencils down. So you can kind of get these properties for, with less competition and less people looking at it, if you're able to raise that kind of capital, right? Like,
yeah.
So,
and the newer stuff too, right? I know who that buyer is on the way out. I'm still trying to, the B stuff's got to get to a price where I know who the buyer is on the way out. And I just don't, right now, I don't know who that is. And so that makes me uncomfortable with it. So like the one that we bought in the beginning of January, we're not even renovating it. Like, it's just an operational play. I'm going to leave all the units so that, and it's a small enough deal. I think capital raising wise, there'll be a lot of groups that will look at it. And I'm just going to wait for the next group to come in and say, oh, look at I can go do these units and get my huge rent lift and pay us a compressed cap rate for that. So that, I think that buyer will still be there. The tricky part's going to be, you got all this B stuff that traded 3 times in 5 years, and there's different scopes, but mostly it's 70% renovated. So if you go buy it now, the way it pencils, you got to finish the 30% of the units. Now what? So who's your buyer in 4 years or 5 years on product that is fully renovated? It's not at a basis for me yet where
fully renovated in a B class area built in the 80s. Like, it's it's a very,
don't get me wrong. We're gonna when I think that flood is coming, we'll be buyers of it. But it's going to be at a basis that I can operationally be a part of that, fix some of the deferred, and then leave it for the next guy and he's going to be able to still buy it from me on a cash flowing basis.
So we've been talking about institutional guys, and it reminds me of a conversation we had about a year ago. So can you give us a status of the sort of the state of the union in terms of the institutionals? Because before you were saying institutional investors, they were cleaning up their balance sheets. They were a mess. They're out of the market because they're trying to work on their balance sheet. You and Kenny were both saying, I think Kenny was saying we were kind of in the second inning of using that analogy of the baseball game. I think you were saying more like third or fourth inning. Where are we today? Would you say we're closer to like 8 or 9 inning? That's why you guys are buying, or are we still? Where are we in the cycle in your mind?
For what type of product?
Multifamily.
It's almost by class. I think we're in probably the 6th inning with a long 7th inning stretch.
For all of them, or class, is that class A, class B?
I mean, if you were to blend it all.
Yeah.
I mean, here's the way I like to think of things. There's 2 things that can define headwinds and tailwinds in this industry. And when I say this industry, I mean commercial real estate in general, but specifically talking about multifamily. One, you have supply and demand characteristics in the market. So you want less supply, you want more demand if you're a buyer. And then on the other side, there's the macroeconomic considerations. There's the things that you don't control as much. There's things like cap rates. There's things like interest rates. There are things like just economic expansion or contraction. Are we in a recession or are things booming? And so if you can get both of those, if you can get the supply and demand characteristics to work in your favor, and you can get macroeconomic conditions to work in your favor, you're going to make tons of money. If you can't get both of those, if you get neither of those, well, that's what we had from 22 to 20 to now 25. We've had neither of those in our favor. I mean, the oversupply, under demand, low rent growth, high interest rates, high cap rates. And so moving forward, the question is, where are we with respect to supply and demand characteristics and macroeconomic, excuse me. 3 sips and I'm already drunk.
How many glasses of wine have you had?
I'm like 3 sips in.
Lotto Real Estate is the new name.
Yeah. And so it feels like supply and demand characteristics in not all markets, but in a lot of markets right now are finally starting to work in our favor. And that's enough that, just like you're saying, it's enough to go in, make purchases, and then say, if we have to hold for 3, 5, 7, 10 years, we can do that. The supply and demand characteristics support a purchase right now. If we can get the additional tailwinds of macroeconomic conditions, if we can see interest rates come down, if we see cap rates come down, if we see lending open up a little bit, I mean, that could basically supercharge the industry. And so it feels like we're in a position right now where, worst case, we can coast for a few years while we wait for the macroeconomic conditions to get there. But if the macroeconomic conditions start to improve, we're going to wish we were buying right now.
Yeah, but what if they don't? That's the concern, right? Like, who knows? Like, dude, if you can predict the future, man, you would,
But that's my point. We still have the supply and demand characteristics moving into our favor. And so it may not be the perfect opportunity to buy and make tons of money, but it's a great opportunity to buy and hold while we're waiting. We're going to make money. There's going to be rent increases. There's going to be enough demand increase that even without the macroeconomic conditions working in our favor, the supply and demand characteristics are going to satisfy our need and be able to support us for the next several years while we wait for that to happen.
But let me play devil's advocate. I mean, we talked about Kyle's been calling for a recession now for the last, I don't know how many years, Kyle.
We know that's you. Don't everyone know you're the one.
Like, in all seriousness, like, let's say macroeconomically you do have a recession and people, it's harder. Now, granted, you're in Class A, so that's maybe a little bit different than those that are in Class C. But if you got a recession, people are getting laid off, unemployment starts going up, are rents going to soften? Is that going to affect, property values? Or Charlie, you don't care because you're not in it for the next 1 or 2 years.
On the value part, it's somewhat, I don't want to say irrelevant, but if I can stress test this where I can maintain the deal and have just positive cash flow at some point in my worst case scenario, then I'm going to still catch the upside, right? Average recession is 18 to 20 months it lasts, and then you're out of it. So if my time horizon is still, anytime that my debt horizon is still outside of 20 months, I feel like I'm in a pretty good position.
You can't ignore like the other trends in just rentals in general too, right? Like the rent to household numbers are just keep going higher and higher and higher. Like if you look at just affordability for households versus renting, like to afford the average house, I think I saw was $116,000 in annual income to afford the average house, and then to afford the average rental, it's like 60,000. And so like there's a huge gap there. And then you're seeing, if we're talking about A class, that new class of like rich renters, if you look at all these major cities, like 35 of the 50 major cities, the share of percentage of rich renters are going way up. In our area, was like, it used to be like in 2019, it was 4.8. Now it's 7.7% of all rentals are these people who are basically just choosing to rent these really nice places with really nice amenities, with things like that. And if you look at all these different things, like I don't see the affordability getting any easier for people buying a house. And if you talk about going into any kind of recession, that's obviously going to get even worse. People are going to have to give up their houses, or they're going to there's going to be issues with housing there as well. And where are they going to go to? They're going to have to come to apartments. And at the same time that happens, as long as it doesn't happen in the next couple months, we're going to have supply shortages as well. We're already seeing net absorptions way up now. It's from the start of 2025. So like, yes, is it going to be great for us if there's a recession? No, obviously people are going to be losing their jobs, and it's going to hit C class a little bit worse, and maybe A class is going to be a little bit softer. But with all of this, like other tailwinds for all these different numbers, I really don't see anything short of a major economic crisis there being issues in multifamily.
Yeah, and to add to that, I mean, I just threw up a chart of absorption rates, and what we're seeing is, for the first time since 2022, we're actually seeing positive absorption across the nation. Obviously, every market's going to be different, but we're actually seeing positive absorption rates for the first time in a couple of years. I just happen to be working on
and positive rent growth for the first time in a couple of years nationally. And
that's literally my next slide in here, is that we're seeing positive rent growth as well.
You make a little presentation for us, Jay? A little slideshow?
I'm giving you a presentation. I'm giving you a presentation.
Jay, what's going on here?
Yeah. So here's the rent growth slide. So we're across the nation where we're almost back to positive rent growth on an annualized basis.
That looks a lot like a presentation, Jay. I'm not going to lie. Like
it is a presentation. I'm giving you a presentation.
It looks like you went to a conference and they said, "We'll email you this presentation after the conference is over. You can download it."
It's actually Ken's. He downloaded Ken's presentation from Limitless, and he's just throwing it.
I will be in Park City next week giving a presentation to a group. So I've been working on it all day. So I just happened to. So to Mauricio, it's a private group. To Mauricio's point, if we do see a recession, I mean, keep in mind that when for a lot of asset classes, recessions are really bad. For housing, recessions can be a mixed blessing. Certainly there are bad things. You're going to see softening rent growth, potentially softening demand, higher vacancy rates. Lots of bad stuff can happen during a recession, but there's also good things that can happen during a recession. I mean, if we see interest rates come down, if we see bond rates come down, we have the opportunity to refi, especially for those of us that have been holding properties since 2020, 2019, that we might be waiting for a refi. It gives us an opportunity. If we see bond yields start to come down, I mean, cap rates, the delta between bond yields and cap rates is historically significant. And so if we see bond yields come down because rates are coming down, or other way around, we could see cap rates come down. And there's about $300 billion in demand sitting on the sidelines for real estate these days. And I mean, I don't suspect that even if we do see a recession right now, that there's going to be any issue with investor demand to buy units, especially with supply decreasing. So,
Jay, before you go on, though, Kyle has raised his hand. He apparently is having a hard time getting a word.
I'm trying to figure out a format that, like, because we used to do our cheers and like all of our drinking at the beginning, and I felt like this was a perfect time. So I just wanted to raise my hand to say this is. You
could actually just really raise your hand.
I know I can, but this would be a good
Or
pivot
you could just tell Jay to shut the up. I mean, that would be the other option.
Well, no. So he started to talk about like things like interest rates, and I do want to kind of dive into what's going on in the economy right now on a macro level and how that can affect investing in commercial real estate. But at the same time, I also think it's a good place to pivot where we do kind of talk about what we're drinking, what we're up to, and everything. So I'll start with Charlie. Like I assume you were told it's called drunk real estate, and you came with a drink in the hand.
I did. I was gonna do a vodka on the rocks, and then I didn't have rocks, so I switched, and I found in my drawer as a present for a closing, I found some Blue Label. So I popped that open.
Look at you!
Had a little sip. So
yeah, a little.
Is that Charlie? Is that
the
standard? Is that the standard that, like, if I want to give you a gift for it's Blue Label or above? Is that the deal?
Yeah.
I mean, standard for anyone, Mauricio.
If I can set the standard, I'm gonna say Pappy then.
Oh,
there you go.
Blue Label is always a great gift. Mauricio, what do you got? What are you drinking?
I'm at the office, so I got a half bottle of just a little Chardonnay, the La Creme, kind of my go-to on a Tuesday afternoon. But yeah, I got to keep it light.
You just have like a whole rack of half bottles. Is that what you're implying? At the
No,
office?
I got a Ralph's, like, walking distance from my office.
Nice. The convenience store down the street wine. Jay, what do you got for us?
So just so you know, I've got a big bottle of the Blue Label here that's been sitting in my kitchen for about 2 years. And so next person that comes to visit me, and all three of you are invited.
I'm in. I'm coming.
I will.
You got to update the label, because always on the label you usually say like how long it's been aged. Just add 2 years to that.
Yeah, I'll go look. I'll let you know. I just grabbed a bottle of Italian red from Tuscany.
Is that from somebody that you don't know who gave it to you, or is it from Costco?
I have like 400 bottles in my fridge right now. I couldn't tell you where it came from. It's not from Costco.
So no, just a public service announcement. If you ever want to give Jay a bottle of wine, please, for the love of God, write a note on the front of the bottle and just say, "To Jay, hope you enjoy," and then your name. That way, when he pulls it 7 years from now from one of his 400 bottles, he knows and can appreciate you.
I think that's a great tip.
Well, we also, if you go back to a previous episode, we also did learn that someone got Jay a wine membership as a gift and then never turned it off. So Jay went years and years of just getting wine all the time, and he neglected to tell his friend that this was still going on. So I think that might contribute to the 400 bottles.
Ask Mauricio if he knows that it hasn't been turned off and he's still paying for it.
My friend is very shy. He doesn't like the shout outs, so I don't give him the shout outs, but he should know that I very much appreciate it. I drink a lot of his wine.
And Kyle, what are you drinking? What do your kidnappers let you drink down in the basement there?
Yeah. So, well, actually,
Kyle, can you put up a copy of the newspaper so we know it's today's date and where you are, that it's actually live today?
Well, no. So I'm obviously up in Canada, and there's some challenges being up in Canada. My parents bought a place by the beach, but like they bought it not that long ago, and they wanted to make some space for me and my family to come and stay. So they quickly threw up 2 bedrooms, but then like the rest of the basement and everything, it's all still under construction, and it's a zoo upstairs with everybody. So this is the only place I can get some quiet. But that's not the biggest challenge. The biggest challenge in Canada is, at the moment, Canadians are not huge fans of America. I don't know if you've been following the news at all, but not huge fans. So what did they do? They've boycotted American booze. They won't buy any American alcohol. And you know what I drink? I usually am a bourbon drinker. And the only place you can make bourbon is in Kentucky. And so you literally cannot buy bourbon in Canada. And so luckily my dad knows I'm a bourbon drinker. And if you guys have ever crossed across the border, and it's a lot easier when you drive than when you fly, but you go to duty free, right? And you can get some very cheap alcohol. So every time my parents live only 2 hours from the border, they cross the border. Every time they come back, they would grab a bottle of alcohol. And so my dad's got a stock of like 3 or 4 bottles of bourbon, luckily. So anyway, that was a long way of saying that he did have a bottle of Wild Turkey 101, which it's a decent bourbon, and it gets you there. It's 101 proof.
Yeah, and so the Canadians are not very happy that with the U.S. right now. The U.S. barely knows Canada exists. Just so you know, like we don't even. Well, it's an afterthought.
The builders know that Canada exists because that's where all the softwood lumber comes from. But that's a good segue into the next segment, where I want to talk about some of the stuff that's going on and how that's affecting multifamily, or hasn't affected yet, or what we're worried about. So I guess I'll throw it out to Charlie. Is like everything that's going on. We got interest rates, we got inflation, we got, as I just said, tariffs, softwood lumber and aluminum, stuff like that. Is there any of these news stories that you're monitoring closely or concerned about, or are these all kind of things that you're just like, it flip-flops so much that we're going to make investment decisions regardless of which ways it goes?
A little bit of both. I think there's a lot of flip-flop, and we'll underwrite going forward if what it looks like, kind of stress test it. The stuff that we're building right now, we've locked in pricing, so that stuff's we're not gonna be hindered by that. And then we'll take it case by case and just kind of see where it goes. From what I'm looking at, it's probably going to hit a little bit. I'm not that opposed to it. I feel like we do need some sort of a reset. So, but no, we'll stress test it. But honestly, like, I've never watched anybody where they speak and then it moves 60 days and then 90 days and then there it is and pulled back. And I've watched a market react to tweets like I've never seen before. So a little bit just feels like you're getting yanked all over the map.
Well, there has been some up. So we talked last week about, a lot has changed in a week. We talked last week about interest rates and the projections going forward, and how JP Morgan said, "Oh, we're going to have 4 rate cuts," and we were like, "Oh, that's a little intense." And that was kind of all based off of one jobs report. And then Jay, I think it was who posted in our chat about the PPI, which most people don't really pay that much attention to PPI, but it's become more of a talking point, because that should be the leading indicator when we have tariffs, right? That prices are going to increase. So Jay, are you, from what you post, you were thinking maybe like this might take rate cut off the table completely? And as far as all of these multifamily investors saying, hey, we're going to see these lower rates are coming soon, we might have to push that off again.
Yeah. So, well, first, let's note that I might be in the minority here. So last week when we were talking, I think I brought up this chart, which is basically the market's prediction for whether we're going to see a cut or not. As of right now, the market's still pricing in an 86% chance of a cut in September. Keep in mind.
But that's down from what? That was down from like 99.
It was 96% last week. Yeah.
Does this include after the PPI came out or no?
Yeah, this is as of right this minute.
Okay.
So this is basically this is a futures market on the federal funds, and so as of this minute,
Tuesday the 19th, we should reference that. Yeah,
sorry, I apologize. Tuesday, so 2 days before this,
because you never know. Tomorrow something could come out, and then all of a sudden.
That's a good point. So a couple things to keep in mind. Number one, we have a bunch of data coming out before that next September meeting. So we have PCE data, which is the Fed's preferred inflation gauge, coming out at the end of this month, 2 weeks from now, or I guess end of next week. We have CPI for August that'll come out before, so we'll have another inflation gauge for August. We'll have our first August inflation gauge before the next meeting. We'll have an employment report. So the August employment report will come out the end of next week or the beginning of the following week. So we do have a bunch more
Is that
data.
a legit one, or is that going to be doctored, or what is that report going to show?
I mean, the guy that's been appointed to head the BLS has suggested that they may halt.
He walked that back though. Like when there was a few days there where everyone was kind of like, whoa, well, this is the first step to Marxism. And then he kind of walked that back. Like, oh no, that's not. I'm not saying that that's something that we're actually doing right now. It was just saying, we're working through this, and he really walked it back. So I don't think, based off of the one good thing about I heard someone talk about the Trump administration and what's going on right now is they're the ultimate A/B testers, right? They will throw things out there and then kind of see the response and then adjust. And so I feel like that's a perfect example of something they threw out there and everyone freaked out and they were like, whoa, we're not actually doing that. Like I was just throwing it as an idea. Yeah. And so I'm not overly worried about that. What it's going to look like though, Mauricio, I do think you have some concerns because like they can't change it this quickly, right? Like they can't change what they've been doing since the 70s and all the methodology and the collections methods and things like that.
And if they do change it, we'll know. I mean, they put out footnotes on any changes to methodologies. So long story short, I mean, Powell and the Fed has said that they're data driven at this point, or they've been saying that for years. And there's a lot of data between now and the next meeting. So a lot of things can change. But the other thing to keep in mind, and let me step back and talk about the PPI report. So PPI, as Kyle pointed out, is basically a measure of wholesale inflation. It's the inflation that's being seen within the supply chain. So what manufacturers are seeing, raw material providers and purchasers, wholesalers and retailers who are buying stuff before they resell it. So it's basically the step before the consumer buys a product. And so for a lot of obvious reasons, it's a leading indicator of what we're likely to see in terms of consumer inflation over the next couple of months. Now, you can argue that in some cases, the manufacturers eat some of those extra costs. The retailers eat some of those extra costs. So just because PPI is high, and it came in very high, doesn't necessarily mean that CPI is going to be as high. But there is going to be some conservation of inflation and margins, eating away at margins.
Well,
so
Jay, I feel like it's important, like just to say how high it was, like give some perspective.
Yeah, it was 0.9% for the month. And so that means over the course of a 1 month period, these intermediate prices went up. What was that?
It was 4 times what they predicted.
It was right. They had predicted
it's like an annualized rate of like 10 or 11%.
0.9 times 12, which is about 11%. So yeah, if we saw this every month, we would see 11% inflation in the supply chain.
And I would win my bet.
And you would win your bet 100%.
Charlie, we've got a bet. We've got a bet there's a bet going on that I think that by the end of the decade, you will test and exceed the inflation rate, the peak inflation rate of a couple years ago, whatever it was, 9%, 8%.
You think between now and
the end of the decade?
Oh, and by the end of 2020, by the end of 2029.
Yeah.
Well, at some point we'll surpass the 9% again.
Which, by the way, I do feel like I have to jump in with this point every once in a while, and a lot of people don't like to hear it, but inflation isn't necessarily that bad of a thing for a multifamily investor, right? Like if you look at the math on both sides, and you got to assume that inflation is pushing the rents too. Obviously, there's a lot of other factors that affect rents other than just price inflation. But if you assume, like if you just look at the numbers, and if we saw 5% rent increases and 5% expense increases, we make out better. Like our investment does better if we have inflation on rents and inflation on expenses at the same rate, and the higher they go. If we saw 10% inflation on rents and 10% inflation on expenses, we're twice as good as we were at 5. So
to some degree. So that does max out at some point, because at the end of the day, if wage growth isn't keeping up with inflation, basically our tenants, our customers can't buy our product at the higher price. And so they get priced out. We have less
obviously wasn't assuming we're going to see 10%. I was just using it as Mauricio's, because Mauricio thinks it's going up to 10%, and assuming we see it on both sides.
I didn't say prices would go up by 10%. I said the CPI would go up by 10%.
regardless. Okay. So anyway, so we saw a really high PPI inflation print last week. It's not consumer prices, although a lot of anecdotal evidence that consumer prices are going up. There were certainly some big numbers in there. The price of vegetables went up 38.6%. I think the number was 38 point something percent for the month, which is kind of crazy. In 1 month, vegetable prices went up 40%. Beef prices were up like 3% for the month. And so there were some pretty big numbers in there that probably skewed the data.
Speaking of big number, can I give you talked about anecdotal evidence. Can I just share my anecdotal evidence here?
You're not going to talk about eggs again, are you?
No. Well, maybe not. So, I
I
moved.
see that in the last
I
episode.
moved,
I
right?
watched it to be a good guest host. I did watch you guys talk about how my eggs, were they flat or down? It was zero. So you paid the same price for eggs.
So I just moved, and so right next to my house is a bagel place. So every so often in the morning I'll go get a bagel. So I literally this morning go in there and get it's like a bacon, egg, and cheese bagel and an OJ, and it was $20. It was $14 for the bagel and $6 for the OJ. So there's my inflation anecdote.
Did it rub your back on the way home too, or is it just?
They rubbed a lot of things on the way home.
So here's my hot take on the tariff piece. I'm going to try to go viral. I don't mind it. I don't love it because we don't have the stomach to actually finish it out. And so I think the ability for all this stuff to come home and production to come here, it's going to take a decade. And there is a 0% chance with elections and how finicky we are that we actually stomach this to get off the track we're on and onto a different track that's better. And so it's all going to spectacularly fail because we're going to do this all. And then in 3 years, it's all going to get rolled back and it's going to have been a complete waste of our time.
Well, and also like it would feel a lot better too if it felt like there was a long-term plan for this. Like I feel like it's kind of just like it's been presented as like, hey, we got an unfair system. We're just going to make it more fair. And these people are taking advantage of this much. We're going to tariff them that much. And like it's, if you look at it statistically, like a 5 or 10% tariff, like we could work with that. Like that's something like I think it was Kevin O'Leary, who basically he summed it up pretty well, where he's like, people just need to start calling it a consumption tax, right? Like many countries have it, many places have it, where you just add another tax on top of consumption that's raising the price. That's all that's really happening. We're taxing the American public, and if it was only a 5 or 10% increase,
but we're already getting taxed on our sales tax. That's a consumption tax too. So we're getting on top of the 8%.
But to Charlie's point, though, we have a broken system, right? We are running a deficit. We're spending too much money, and we got to either reduce expenses or increase income. And it doesn't look like we're going to reduce expenses. Like if that's what we ran, the platform that was run on, and the deficit's projected to get higher. So what do we got to do? We got to increase income somehow. And this, of all the alternatives of actually increasing taxes on our tax rates or business taxes, or, reducing Social Security, or doing all the alternatives, kind of increasing a consumption tax a little bit, basically by doing the tariffs, isn't that bad a thing. If I felt like that was the plan, like we're just going to fall somewhere between 5 and 10%.
Yeah, but I don't feel like that. This is my own personal. Now we're really getting off topic, but what the hell? Couple glasses in, but I don't think the tariffs have anything to do with income and expenses. I think this is leverage to get other stuff done. Like, hey, I want leverage over other countries to negotiate either better trade deals or just something completely different. And unrelated to the amount of income we're producing. It's just a leverage. It's a bargaining chip, in my opinion.
I guess that's my point, where it's like, you feel like that's the plan. Another person feels like it's a different, like we don't really know what the plan is. And
wait, we don't know what Trump is up to?
Exactly. And so I guess that's like, there is a path though. There is a path where it turns out okay. Please stop it with Canada though. Like, with the softwood lumber, like I would love to just we have
51st state, baby, for 51st state.
We're supposed to be breaking ground like later this year. And like, I would love to just not have to check that number every day. If you want to talk about things that we're looking at.
Okay, let me get back to the point that people care about.
Let's get back to the TED Talk that Jay had planned.
People care about. Yeah, the 38% increase in vegetables. Yeah, that's what the multifamily investor cares about right now.
I apologize. But where I'm heading is, what does this mean in terms of rates? And so a week ago, I think we all agreed September, barring any crazy releases between now and then, we were going to see at least a 1/4 point rate cut. Today, we may have seen that one of those releases that kind of derails that plan. So the question now is this PPI report some leading indicator of a bad PC report that we're going to see at the end of the month, which was for the same month? I mean, PC shouldn't be much higher than what we expect because it's going to be consistent with CPI to some extent. But we're going to get CPI in September for August numbers. And so will the July PPI lead to higher numbers of August CPI before leading up to the meeting? And the unemployment numbers, are we going to see a better employment read than we saw last month? Which is, I mean, it's one of the weird things about Trump complaining about the employment data. If he really wants rate cuts, the best thing he can do is play up the fact that employment's softening as opposed to the fact that it's all manipulated and employment's great. If we do get a good employment reading, then there's less chance of a cut. But here's the biggest thing to consider. Jerome Powell, who doesn't make the decision on rate cuts. It's a vote. There are 12 people in the committee, and they all have to vote. They need a majority to do a cut. But the reality is, Powell is the Fed chair, and he has a lot of power. He's a huge fan of a guy named Paul Volcker, who was the Fed chair back in the early 80s when we saw inflation running up to 10, 15, 16%. And during the 70s and 80s, for those who aren't as old as I am, basically what we saw was this flip-flop between high inflation and high rates. Inflation would spike, the Fed would jump in and spike rates, bring down inflation, they'd bring down rates, and then the inflation would spike again. And we had this cycle of high inflation and recession between 1968 and 1982. We had 5 of them. We had 5 of those cycles. And Paul Volcker came in the early 80s and basically said, nope, I'm putting a stop to this. I'm going to raise rates. I don't care how high they have to go and for how long they have to be there, but I'm going to squash inflation once and for all. And he did that.
Yeah, but how much was inflation when he was squashing it? It wasn't 2.5%, 3%.
It wasn't. But the concern.
How much was it? It was like 50. No, 50. It was like up there in the teens.
But the concern during the 70s wasn't just inflation. It was this thing called stagflation, which was a coupling of inflation with a softening economy, with high unemployment and other soft economic conditions, low wage growth. And so it was a difficult decision to raise rates because it basically took a bad economic situation, a softening economy, and made that worse in order to fight inflation. And so a lot of people are suggesting, and I'm not suggesting we're anything like the 70s or even like the 40s right now, where we have massive stagflation, but we do have the beginnings of it. We're seeing softening in employment, softening in GDP, softening in the economy. We're seeing inflation start to creep up. And so Powell has a decision to make. He's only going to be around for another 8 months. And he has indicated that he does not want his legacy to be inflation. He has indicated that he's okay with recession because recessions are pretty standard. Recessions they come and go. They're cyclical. He doesn't want inflation, and he certainly doesn't want to be the guy known for stagflation. And so my thesis is that there is a much greater chance that Powell, and you can say he's being political. I don't care. I don't believe he is. I think there's a much greater chance that he is conservative about cutting rates versus he bows to the pressure and cuts just because we saw a couple bad.
Yeah, I agree. I don't think.
But I have a question though. As a buyer, like right now, I don't want there to be cuts. We have a few floating rate deals that if rates come down 50 basis points, it doesn't even really move. Like, at some point, you need the buyer, the sellers. Everyone just keeps waiting for this, and they're going to hold on. And there's so much maturity coming in 2026 on all those 311s or the 233s that were I kind of benchmark it at like March of 2021. If you bought after that, that deal is probably in a world of hurt. So that means that means that maturity is March of 2026. That through March like July of 2027 is when all this is going to come to a head. Nobody really knows what the bridge guys are going to do with extending maturity. For them to go back, that is a huge deal to go past the 5 years. So I just feel like there's this influx that is coming. And if the rates can be higher when that happens, that's just a better buying opportunity for us to be in this position.
Let's talk about that because what you said about 2026, everybody was saying about 2020, end of 2024, end of 20 or between 2025, and so we've been joking that it used to be like survive till 25. Now it's like persist till 26, and then it'll be something like I know they're 3 + 1 + 1.
Yeah, but I think that the survive to 25 was for the people that owned, right? I'm not looking at this not from an owner perspective. I'm looking at this from what is the best from a consumption standpoint over the next 24 months, and lower rates does not help.
So in your perfect world, rates would stay high because that makes the stress continue, and you're all about taking advantage of the stress.
And the bad stuff is so bad that a 50, it's not going to make a difference. So I'd rather on the sell side.
Yeah, but Bennett's talking about a 2 or 2.5 point, 250 basis point. That would make a difference, though, right? 150 to 200 basis point.
Well, but a half point, yeah, it wouldn't make that big, but there will be people who are up a creek right now, and it gives them more options too, though, right? Like if you can refi or you can sell and maybe get you're currently underwater. Let's say you have a $50 million loan and you're looking at a $45 million valuation. If rates come down enough, because we're kind of right, to your point, we're kind of right at that point where the loans and cap rates are kind of pretty even, like they're right around the same. So if we could get even if you get that 50 bip positive arbitrage, that could make numbers pencil a lot better for some people and help them get out of some of these things, and it would increase flow of properties out there. Hopefully it wouldn't have all these people come back to buying, because we already, like, I don't know about you guys, but we're still seeing best and final rounds. We're still seeing there's still people out there buying. It's not
but Charlie doesn't want that. Charlie doesn't want to bail anybody out. He wants to go in there and just take advantage of.
Okay, so the bailout people are the early to mid 21s. If you are November of 21 and on, it needs to be 50 basis points. Does not save you. It doesn't even come close. I mean, we're looking at Phoenix stuff that was 1980s product that traded for the same basis that we're now buying Class A new build for. Like there isn't a hole in rates that can dig them out of that stuff. I mean, we're looking at some stuff where we see the debt on an 80s deal is $278 a door, and maybe you could sell it for $170 today. So 50 basis points does not move that.
You're not saving that one.
Nope.
Yeah, and so just for anybody, just
back to the TED Talk presentation by Jay.
This gives an idea for anybody that's watching this. Basically, it's just a chart of delinquencies in multifamily, and what we see is where we are, and this might be difficult to read, but basically at about what's that number? 9 billion. In delinquencies right now in multifamily, that basically puts us back in 2009, 10, beginning of 2011 territory in terms of delinquency. And then if you can see the graph on the left, basically just from a percentage basis, or actually I guess that's an absolute value basis, we're pretty close to where we were back during the Great Recession in terms of delinquency. And just to put some data behind it, I mean, there's about $5 trillion in commercial debt out there. $1 trillion of that is multifamily, and we have about $1 trillion in commercial debt coming due in 2025 alone. Right now, we're about $400 billion in delinquency on commercial debt, of which $100 billion or something is multifamily. That's at least 30 days delinquent. So, I mean, there's a lot of debt out there, and there's a lot of risk out there. And I'm with Charlie that I think it was Charlie that said this, that it's going to take more than a quarter point to basically help a lot of those investors. And I think it really boils down to, are the banks going to be willing to kick the can much further, and how far are they going to be willing to?
They've shown that they have, though. Like that's the thing. Like everyone's been calling for this cliff of of delinquencies or like everything's coming due this time. And then the bank, they learned their lesson last time. They don't want to own these properties.
To be fair, and Charlie, give me your take on this too. Like the bridge loans that were happening in 2021 were what we call 3+1+1. And everybody assumed those were 5-year loans, but really they're 3-year loans, which is, I think a lot of people were thinking after those 3 years, meaning 2025, but they did have that optionality of that 1+1, but those are ending.
And every single lender is waiving every hurdle for the extension. If you're willing to even make anywhere near a payment, your debt yield hurdles, all that stuff goes away. So they're basically just without anything, they've become a 5-year loan.
Right. That's where your March of 2026 number comes into play.
That's where the 2026, because it's what the CLO market allows. It is uncharted territory on what is going to happen when you get to the final 5 years. Can they add 2 more years?
Well,
What is their CLO
a lot of these
covenant?
loans, they could do whatever they want though, because like all of these numbers that people are quoting, those are all CMBS and like, you know, bank loans. We're not talking about Fannie and Freddie. Fannie and Freddie, yes, the delinquency's gone up, but we're talking about the delinquency went from 0.3% up to 0.6%.
That's what they didn't. But they didn't do any lending. Nobody went to them because they were like, sorry, it's on a T. We're going to do this on a T3. And the bridge guy's like, hey, we'll do it on a forward T12. You tell
Right.
like,
But those
what is it gonna
bridge
be?
guys, I guess my point is like they can kind of do whatever, like they create the terms on these loans. Like whenever we
But
do
they're
these,
just the middleman, though.
Yeah.
That's the problem. So when it comes to the 5-year end, they don't own those loans anymore. They're just servicing them and cutting their arbitrage in the middle. They've dumped them all into the CLOs. And I mean, we have a loan that I think 20. It's in like 15 different tranches. So it's split everywhere. And so to get all those people to say we'll go beyond the 5, I mean, it is a cluster. And nobody really knows what. I mean, we've had deals that we have had to make loan mods on that were 2022 buys. I'm wide open to talk about it. Right? I hate the groups that are like, we're fine. Like, listen, everybody, if you bought a deal in 2020, end of 2021 on, you are having problems. And every single lender has worked with us on thank God we have, it's like 3 out of 30 something deals. But nobody knows when you get to the question of what happens with maturity, what happens when you get to the end of 5 years. It's like a black hole. No one knows what's on the other side of that.
if we can get down even a half a point, you know, 50 bips, and before we get to kind of, you know, all of that, you know, the March 2026, if you want to use that number, like if we can get down significant, like 0.5, yes, okay, there's going to be a lot of issues. There's going to be the ones that are, you know, have gone down in value by 70%. There's no saving those. But these, if they're good properties, and we're just talking about like loan rates and rate caps and things like that, it's not fundamentals with the property that are having issues. I feel like that could almost stave off like catastrophe, I guess is the thing, where you'll still have some blood in the streets, but it won't just be like people running with their properties on fire down the street.
Well, the banks learned their lesson in 2008. They don't manage well. And so in 2008, the thought was, hey, we've got a delinquent property or delinquent borrower. We take back the property. We manage it until we can foreclose or get cash for keys and get it sold. And what they found was they would take back a property at 75% occupancy. And by the time they got it sold, it was at 40% occupancy. And it was in much worse condition. And they lost a lot of value on those properties. And so banks seem to be a lot more intelligent these days and realize that they're gonna capture the most value if they either let the operators who are doing a half decent job but are succumbing to bad macroeconomic conditions, if they let them keep going, or if they take back a property and have a buyer in their back pocket that they can turn it over to at market value with some equity. And so basically what I've seen, and I'll defer to Charlie because I mean his company is 5 times as big as ours and he's seen a lot more. But what I've seen is basically banks are either figuring out a way to make it work for the time being, or if they are taking back properties, they're doing so properties with equity, and immediately reselling them to a buyer in their back pocket.
Charlie, before you answer that, here's what I'm seeing, and you correct me if I'm wrong or give me your perspective because you're in the middle of this. But from what I've been hearing, because I'm the attorney, right? But what I've been hearing is that banks want to do that latter. They want to be able to flip it to and go negotiate with another buyer, i.e. MC companies. So they will show it to you, Charlie, and say, Charlie, we've got this deal. It's struggling. These guys suck. We want to get rid of it. Will you take it over? And you're looking at this and saying, dude, it doesn't even cover the debt. Forget it. It's not worth it. I mean, are they going to other buyers, potential buyers like you guys, and then you guys are passing on it?
Yeah. But they're not taking a big enough discount yet. That's the problem. Like they want 100 cents on the dollar. And you're like, well, I'll give you 60 cents on the dollar to your loan.
Or they're trying to say, hey, like keep the same size of the loan, but we'll give you, 92% LTV, and we'll give you a line to do renovations of an extra $2 million. And you're like, wow, the number.
Yeah, you're not biting yet. You're not biting.
No, but it's coming. Everybody has acquiesced because a lot of the CLOs have covenants that state if you mark to market one, you got to mark to market everybody. And so they'll do whatever they can to not mark to market that one because they've got a bunch of other loans in there that they do not want anybody to know where the value is on them. And it is deep and pervasive. It is.
So we don't lose anyone. Who wants to explain CLOs? I mean, they're kind of like the CDOs of the financial crisis, but CLO, explain what that is and why it matters.
It's just the secondary market in which you go collateralize the debt funds don't keep the loans on their balance sheet. So they go borrow to you at a certain spread over SOFR, and then they go sell that in a secondary market in different tranches at a slightly lower rate, and then they just take the arbitrage in the middle.
I feel like they just changed the name. It used to be collateral debt obligations. These are now CLOs, which is collateral loan obligations, right? Are they any different from the old CDOs? Or they just changed the names because CDOs have such a bad rap?
Probably.
CDOs was before my time. I mean, unless it was a line in a script, I did not deal with CDOs.
CLOs, CDOs are historically real estate based type loans. CLOs are historically corporate leverage loans against assets, not non-real.
Same idea though.
Real
Basically, the idea is what Charlie was saying is basically these loans are made and then they're packaged together, and they're all of a sudden there's a big package of a bunch of different loans. And if you show distress in any of those loans, then people put a microscope on the other ones and they want to just act like everything's okay.
And cut. Charlie, anything else you want?
Well, no, the only one more thing I did want to point out though is I don't know if you guys are getting into this, and we only have one property we're dealing with this issue, but it's been an issue, and it wasn't 2021, it was 2020 we bought that one, but we bought it on a floater, and the rate cap is what's the killer right now. And just to give perspective, when we bought this loan, we had to set aside $900 a month for our new rate cap purchase. So that what they do is they make you escrow money aside so that when your rate cap expires, it's basically an insurance contract. When a rate cap expires, you have enough money set aside so that you could buy the new rate cap, right? And so it started off at $900 for years a month. And then all of a sudden hit the fan with inflation going to 90% or 9%, and interest rates went way up, and they had no idea which way they're going to go. And all of a sudden we got one, they're like, okay, it's going from 900 to 9,000. We're like, okay, 900, 9,000. Okay. You know how much the next one was? $78,000 a month was all of a sudden what we were having to escrow. Now it's not that high anymore, but it's still very high because they have all of these rate cap rules. And I'll vent a little bit here, but the rate cap rules is they make you set aside for a 2-year rate cap at a 125% of the value, even though you only have to buy a 1 year. And so like they're reserving all of this money every month, and it's just killing your cash flow to the point where like it's it's not killing the deal. But when you couple that with on this deal, like our taxes are still in protest from 2022, and these tax protests, they haven't caught up with the fact that values have gone down, and they keep trying to raise your taxes 10% every year, even though the market's gone down 30%. It's like I guess what I'm getting at is there's good deals that are just getting crushed by this weird interest rate market right now, where they still haven't taken the upside off of it, right? They still haven't taken the chance that inflation's going to go up and interest rates are going to increase a little bit. And I just hope that like some of these deals, that if we see that 50 bips come down and they kind of take that upside off of the risk, that things like rate caps are all of a sudden going to be like, okay, we don't have to set aside rate caps for the possibility that rates are going to go back up to 6%. We don't have to set aside that stuff. And then your escrows every month will go down. And then like the market will stabilize a little bit. Like you'll see some transaction volume instead of everything that's transacting now is basically distressed. So you have like no comps to go against for values. And it could kind of put at ease a bunch of these on the bubble properties and stabilize it. So then, if we're just dealing with the ones that were bought at the height of the market, they overpaid by 20%. Like we're just dealing with those ones. We're not dealing with all the kind of the middle of the good properties that are doing well, but it's, we just got a bad loan at a bad time, I guess is my thought was.
Yeah, but I want to buy those ones. Those are the ones I want to buy. I want to buy the good performing ones that are just struggling because of the macro. I don't want to buy the ones that are in the problem is everything that's the 2022 stuff is just the rougher, for at least what we saw in Phoenix. The stuff that was bought in 2022 is like the stuff you don't want to. The bottom is just so low that I don't know if it's got to drop significantly before I even want to own that piece of real estate. So.
Yeah, I mean, I guess it's a tale of two, like. Every investment company, you're doing both sides, right? You already have properties that there's going to be certain macros that make that perform well. And there's going to be the other side where you want to buy properties, right? And there's going to be certain things there. And what do you hope for in the balance? Because they're usually at odds. All right, Mauricio, any final questions? I know you had a lot.
I was going to preemptively apologize for Charlie about the upcoming top 10 list that you have come in. So I just want to make sure Charlie knew that I'm very sorry.
I did this. You know what? I had another top 10 planned, but then you literally, what was it this morning? Dropped out of our fantasy football league. And so out of spite, I'm going to do a fantasy football top 10. And I'm going to give my top 10 rankings for the upcoming fantasy football league, knowing that it's just, you are going to hate it so much.
You see what I got to deal with, Charlie? The crap I got to deal with.
By the way, just so you know, if I was to age 10 years, as long as I woke up tomorrow and I aged 10 years, I would do it. I don't want to miss 10 years of my life, but for the $1 billion, I would just wake up and be 10 years older. And then that would be fine.
As long as I could, like, I'm in the same, like, as good a health as I am right now, like, assuming like you didn't catch like some weird disease or something along that 10 years and you wake up and all of a sudden you got,
as long as I don't get like osteoporosis along the way, I'm good.
Right. Yeah.
I was hoping we could do like a top 10 shows that Charlie's been on. The most popular.
Do you want to? All right. Do you want to pivot?
Top three shows that Charlie's been on.
That's a good one.
Great. Grey's Anatomy. Is that one? That's got to be the top.
And we already said Las Vegas. Obviously it depends on your demographic.
Veronica Mars. I mean, that's,
if you're asking my wife or you're asking me, obviously I'm going to put Las Vegas above Grey's Anatomy. But we'll punt it to Charlie. The top 10 most fun shows let's go with 3. That's a good number. You're 3.
For me to work that I worked on.
Yeah.
Number 1 by far was Las Vegas.
And was that you talked about I can't put it. Is Vanessa the same gal that did 90210?
Yes. Josh Duhamel is one of the.
I was going to say Josh Duhamel's on that show.
So I'll tell you I'm going to tell you a really good Josh Duhamel story. So I am in high school. I had braces and I chose to do the clear braces, which is a really bad idea because they turn yellow. And so I had no dates in high school was a real tough go for me. And I dated a girl briefly in like 9th grade that broke up with me for the linebacker of the football team. And it destroyed me and crushed all my confidence. Cut 2 years later.
She's going to see that. By the way, she's going to see this podcast and she's going to regret it.
Yeah. So we're in the Minneapolis airport, come out at like mid-July. and Minneapolis has like the 2 check-in gates by each other, and mine's going to Los Angeles, and there's another one going to a different city. And I hear Charlie, and I'm like, oh my gosh, what are you doing here? And what are you doing? She's like, I'm a lawyer and all this amazing things, and and is, you know, crushing it in the legal world and epically like almost making partner. What are you up to? It's like, oh, this is going to be a real hard explanation. So I said, I'm in Los Angeles. I'm, you know, doing television work. And you just watched her face just sink. Like you don't even say anything. Like you're just the dude in the background walking by. And in that moment, I get this huge bear hug from behind. And it was, this guy goes, give me all your money, as a joke, and like bear hugs me. And it was Josh.
No
being super, yeah.
way.
Yeah, it was epic because
awesome.
he was coming back from North Dakota for from his 4th of July back then. And I was like, oh, Josh, yay. And then it was like, I didn't need to go to reunions after that. I was like, that was just tied a neat little bow. It was perfect.
You couldn't have planned that. Like
No,
even if you'd seen him in the airport. Oh
Yeah, it was great. So that show, him, James LaSure, they were just wonderfully kind people. Molly Sim, like all of them were epically cool.
So that's obviously number one. But you've been on like Grey's Anatomy, Veronica Mars. You were at CSI.
Veronica Mars is great. Kristen Bell is super cool. Taught me running charades. Used to hang out with her a bunch. She was wonderfully, like, as nice as she appears. And then, what was the other really fun one? Probably Ghost Whisperer. Jennifer Love Hewitt was super nice too. So those were the
I had
3
such a big
nicest
crush
shows
on her
I was on.
when I was younger.
Which one was that she was in?
She was in Party of
Party of
She was in
Five
Party
was
of
the
Five.
original one.
Does Carol
Party of
know about
Five.
this?
Does Carol know about this?
Yeah. Does
Carol
know about this
would tell me, yeah, go for it. Good luck.
So those are the 3 best, like just most fun to shoot and have a good time on, and kind cast and fun.
So Jay, he already said he liked the last hypothetical. I hope you have a good one for him this week. You didn't plan for this?
I didn't. I don't have a good
It's
one.
like when we were at Limitless. When we had Limitless with with our guest, he was put on the spot and he came up with the absolute lamest. Would you rather?
Do you remember what it was?
Would you rather shoot yourself or would you rather watch
No.
a
Good God.
TED Talk?
No.
Wait, is this the one that we're airing this episode next week? I've heard
That's
nothing.
right. That's coming out next week. The infamous Limitless episode.
Oh yeah, so this is us talking up our episode that's being released next week. Oh, it had the worst hypothetical of all time.
Charlie, you don't have any good hypotheticals?
I feel like staying silent on this, I'll still just be better than
Would you
the other
rather?
co-hosts.
Would you rather?
I'm
Here's
good.
a good one, Charlie. Would you rather get to 30,000 units, or would you rather win an Oscar? Or not an Oscar, sorry, whatever the TV one is. An Emmy.
30,000 units.
Yeah.
You want to know why? Because when I wake up the next day, I still own 30,000 units. After you win an Emmy, you could be fired and not have a job for 7 years. That is literally, it is the drug of that industry. It is the only business. And I have so many friends, some that have made it really, really far and some that are still in it and they're not. And it's the drug that is, you could be unemployed on Monday and by Friday have signed a contract and be cast and make millions. And and you've been unemployed for 4 years. Like you can't just be a CPA and be like, oh, by the way, just kidding. Ernst & Young wants to make you CFO. You've been on like, there's that, like, if I just quit now, what if this week is the week? And that is that drug of it. So I would take 30,000.
When you started in the acting business, what restaurant did you work at?
I worked at a restaurant called Barefoot, which is across from Cedar Sinai.
Wait, did you just throw that out as a joke because that's what actors always do? Is they
All of them. 100. You have to.
Oh, that's awesome. Didn't Brad Pitt like work like twirling street signs or something while he was trying to make it? He had some crazy story too. I'll throw out the one hypothetical that's always been my favorite, and it's: would you, for $1 billion, but you can never leave the state of Idaho? No, Idaho. I always do it because
Wait, you're
to
going to
make
give
fun
me
of
$1
AJ.
billion to live in Idaho for the rest of my life?
Yeah, you
Done.
can't leave.
I live in Idaho. I spend most of my summers in Idaho. I just got to live through like 4 months of no sun. That's fine.
There's a lot of people say no to that, but I would say yes. I would. There's a
I
lot.
think Idaho's actually on my plan B list.
How about this? You never have to pay for food again, but you can only eat at the same 5 restaurants for the rest of your life.
Done.
Done.
I would pick two like low end, really like that has everything, like Cheesecake Factory or like what's another one that it's got like a huge menu with everything, and then you pick three high end chains that are in like every.
I have a
major
question
city.
then. Would you, if you went on like 4 other couples want to go to dinner, could you go and just not eat? So you still get the social piece of it, or
Yeah, you can go to a restaurant as long as you don't eat.
Yep.
yeah, I do
Drinking
it.
water. Oh, okay. What about drinking? Can I go to a restaurant and drink though? Still, like that's a quite because like if you
I'll allow it.
yeah, then
I'll
I'm
allow
good.
it.
I'm in.
Yeah, me too.
I'll allow
No,
it.
I think it should be you can go to any restaurant, but you can never drink. That's another one. Never drink again, and only eat in 5
What's the
restaurants.
number? That's going to depend on the number to me.
Dude, I feel like $1 billion is a lot. Like I could do.
Oh, yeah,
pretty
I
much-
would do that for $1 billion. But like if we're talking about like 20 million, I don't know. It's like I mean,
Never have a sip of booze?
yeah. I feel like there's a lot of people that do it, but it's become I'm such an introvert naturally, and that's kind of like one of the reasons, low key, that I like wanted to start Drunk Real Estate is I don't open up until I have a few drinks, and so like
low key.
yeah, low key is that
Are you like 17 years old?
I'm hip to the lingo, Jay.
What adult says low key?
Jeez, you got no Riz over there. That's like
You know what that word is.
I've got W Riz.
Kyle, what age are your kids?
my kids are 8 and 10, so
Yes,
like
you know Riz.
of course I know
11
it
and
is.
9.
And,
I
like,
know what Riz is.
We just apparently like 6, 7 is the thing. Like you're supposed to do 6, 7. Like I just learned about that.
Here's my problem with my kids. Mine are 11 and 9, but we homeschool, so we're like in a little bubble, and we only use the same terms as we talk. So I don't get to learn any new terms.
They know the word syndication very well.
very well. They know
My
the
kids-
word capital calls. They're very well versed on that
By
one.
the way, when they say SEC, they don't mean the football division. They mean the regulatory.
All right, let's wrap this up. Plugs. Charlie, this is the segment where we talk about what we're up to and anything you want to plug. So you got anything you got going on?
Yeah, we got a new development going on called Rita Ranch in Tucson. We love the deal. Ross, one of the founders, has been there 42 years. We're one of the, it's a secondary market, but we're one of the 2 developers there. So the land we own is always the best piece of land in that area. And it's acts like a Midwest city, which is just consistent, steady down the road. So we're super excited about that project. And, we try to be the group that can bring you the diversification of investments that you want, give you class A, class B, whatever you have, and however you want to put your portfolio together. So
Nice. Mauricio, what do you got?
If you're a syndicator and you're looking to raise capital compliantly for less than a cup of coffee 7 times a day, times whatever, come join the program.
Have you seen the price of coffee recently?
It's for less than a cup of coffee, except you're gonna buy 7 cups of coffee a day.
Everything's less than a cup of coffee these days.
We meet weekly to answer your questions on compliance, because my concern is that you're out there naked without a lawyer. And so come ask a real lawyer questions. And we meet every Wednesday. Coachingwithmauricio.com if you're interested.
by the way, we are 506C. Don't worry, Mauricio. That's why I could say that.
No, I know.
Yeah, some of us look pretty good naked, Mauricio. So don't. It's not that bad of a thing. Jay, what do you got?
Especially Charlie. Apparently, if you look at if you guys want to Google Charlie on Google,
the shirtless pics.
See some shirtless pics of Charlie. Knock yourself out.
Jay, what do you got? There's just no pictures to back that up.
There's just no photographic evidence.
Wait a second. Hold on.
You're not going to go actually get a picture. You know what's best is that he has one readily available.
Oh my God.
So my kids actually found this picture of me.
And you still can't tell
in a
what
box.
shape you're in. Yeah, I still can't tell.
I was pretty big.
Good
Okay,
posture, by the way.
let's see. I'm not going to plug
Which TED Talk do you want to promote?
Nope, not plug my wife's company this week because she launched last week and she got so many orders that she didn't sleep all week. Nope. Don't order this week. Order next week. She needs a couple days off. We have a new development. We're doing a ground up build, 351 units in Dallas. Yep. And so after you invest with Charlie and MC and Ken, come talk to us because we've got you
got to diversify across regions, right? So you got Arizona and Texas.
Absolutely.
If you look at the top list, it's the top 2 states for growth.
Yep. we're buying all of our softwood lumber from Australia. So
Manzanita trees. It's going to be beautiful.
We're getting Brazil nut trees.
Exactly. Yeah. So anybody that's interested, reach out to me if you're interested in a ground up development in Dallas.
As always, I was hoping I was going to get to plug Jay's wife again. That was kind of nice last week getting to plug her, but next week I'll plug her. As usual, I'm going to plug my wife tonight. Go check her out. Instagram, Badass Investor, YouTube, Badass Investor. Much better looking than Jay, and smarter too. And goes to all the same conferences, talks about the same. So you might as well follow her.
My slides are better.
That is true. Your slides are better. She's not the. She's more of a presentation person than a slides person. All right, that's all I got, guys. Great episode.
Charlie, thank you
for having me. That was super fun. So I
we appreciate it.
We still stretched it to an hour and a half. Apologize for that, Charlie. But
no, it's perfect.
No, I had a great time.
Thanks for coming on, buddy.
Yep.
Appreciate it.
Yeah, appreciate it. Great meeting you.
And as we said, next week we're replaying a Limitless interview. Right, is what we're doing. You guys taped a Limitless episode while you were down there.
It was great because we didn't have Kyle or AJ, so it was a great episode.
Yeah, I got some ladies there. It was nice.
Yeah, so we had another MC Companies. Is she technically MC Companies?
Yeah.
Okay. So we've got another Kenny connection.
Yeah, geez, it's all Kenny all day.
Are we gonna plug Kenny's wife then? Is that what we're doing?
Well, I don't know. I don't know Kenny well enough to plug his wife, but
He'll be on next week.
Yeah. All right. Sounds good. Well, thanks again, Charlie, for joining us.
Thank you.
So next week we won't see you guys, but the week after that, I will see you next
that
Thursday.
That Thursday. Yeah.
See you guys.
See you guys.